All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Very interesting morning in the market here. We saw S&P futures last night get halted on a limit down, which isn't unusual nowadays, right? We've seen that several times. What is unusual is that when the market gaps down, it doesn't get halted right away because it gaps down 7%. And today, instead of the market being halted, we saw some money come into the market and some money come in on some big volume here. And it's been very interesting to see where that money has gone. And I think if you're looking to say, okay, you know what stocks do I want to be involved with when all's said and done? You can look at today's action and go, okay, I want involved in those names. Walmart. You've heard me beat the Walmart drum to death. The Walmarts of the world, even UPS, FedEx, Netflix, Procter and Gamble, a little bit of Walgreens. Amazon is green here, up about 1% this morning, even though the market's down about 80 points. But we are seeing a little bit of differentiation in things where the stocks that you look at and go, okay, some of the action that's going on out there actually improves these companies a little bit, where the stocks that you go, okay, I have no idea what the business is going to be like going forward. For example, the Royal Caribbeans of the world, the American Airlines of the world, where nobody knows what's going on, right? It's just one where their businesses are basically cooked right now, so no one knows how to value the stocks, and those stocks are getting hit, and they're getting hit very hard. The Halliburtons of the world, we can name a lot of them, the Chipotles of the world, where, yeah, will they come back to business? Probably, but is it going to happen tomorrow? And what are the impacts? There are just a lot of unknowns, and we talked about that yesterday. Another thing that's very interesting about the market this morning is that typically when we have seen S&P futures go limit down, we have seen the TLT make a big move up. What does that mean? That means interest rates have made a big move down. But take a look at the TLT here today. Market limit down, and instead of the TLT flying high like what it had been, TLT just kind of calm. Not a lot of interest rate movement. So a very different limit down style day here today for the market. You'll also notice market getting hammered today and the VIX is down. It's just one of those things where the relative value of the VIX is just absolutely monstrous right here. And, everything about it says it's not going to hold here, including how the options are priced for the VIX. It's not like you can bet on the VIX going down to 50 and get a good value for that bet. Because it's one of those that traders are looking at and saying, yeah, that's ultimately what's going to happen. If we come into an April option and say, hey, let's just hold this for a ride down to 50, and I buy the 70 put, that's $16. 54 is my break even, 38 is my double. So to double my money on that, I need the VIX to come down to 38. That's probably a realistic expectation, but in the next 30 days? So it's not very good value, to be had with it. And, when we look at individual names and individual stocks, the option prices continue to be, insane. If we compare them to what they've been over the last years, but fairly priced given what we're seeing in the market, to where there's zero price stability and all sorts of just massive, fast, quick moves. Take a look at FedEx this morning. This is one I've been watching, and I don't have a position in it, haven't traded it, but take a look. This is the 1 minute chart on FedEx. And we have the stock open at 90, and within 1, 2, 3, 4, 5, 6 minutes, the stock breaks 100. And then in 2 minutes, the stock comes all the way back to 94. So we have a 6% move in 2 minutes that is erased the next 3 minutes later with the stock rallying 6%. It's just one of those where, when you're talking about that type of movement, the options are going to be a little bit insane. They're going to be a little crazy because they have to account for it. Look at Netflix this morning. Here we go. Boom. 300 up to 330. This stock rallied 10% off of its gap. And within, 4 minutes, it's now moved down $5. And this isn't unusual action. This is becoming more normalized action for these companies, for these stocks. And so it's one of the reasons why we are seeing options, where they are here. There's a lot of fear. There's a lot of panic out there. There's a lot of unknown. And we've spoken to it, and, as we see the short-term technical signs, change, and we see some, challenge triggers come into the market, we'll go out and trade them. I'll go out and trade them. I'll talk about them. I'll show what is changing and how it's changing. But so far, nothing is changing. But I wanted this morning to go out and talk about the end result of this coronavirus panic and how it will play out. Now, whenever we look at a situation like this and decide how it's going to play out, we're playing a little bit of predictor. We're dealing with variables that can change very quickly. And we're dealing with nebulous kind of time frames, right? What's the time frame for this? We can only kind of guess there, but I'm going to attempt to go out and do that here this morning because as I've sat back and watched the markets, as I've just observed, as I've absorbed, it's very clear to me what the path of least resistance and what the incentives are. And so I'll give you a little bit of background here and go out and talk about what I think ultimately happens and how things play out and kind of my mindset going forward. Now, please know, it doesn't mean I'm going out and buying big today. Doesn't mean I'm going out and buying big tomorrow. Doesn't mean I'm making any changes right here. But it is something that I think is very probable for a variety of reasons, and so I'll speak to those here this morning. But a little bit of background. I graduated with a degree from the University of Utah in economics. And when I went to college originally, my plan was med school. I'm going to be a surgeon. The neurosurgery fascinated me. And that's where I started out. I started out taking those classes, the biologies and the physiologies and the anatomies and all of those, and started taking those classes. And then I went to do a little bit of work at a hospital, and I absolutely hated being in the hospital. Hated the environment, hated just how I felt in there, how I felt when I left there. It just was a feeling I couldn't get over. And I had to take a hard look and say, can I do that long term? Can I basically live half my life in a hospital? And for me, the answer was absolutely not. And so I kind of jumped majors. I jumped around a little bit. All right, what about the research side of things? The microbiology, the molecular biology. And I started taking classes in it, and I was spending a lot of time in labs looking at microscopes and studying, different things. And there was no excitement in it for me. It was kind of boring. It was kind of mundane. And I know some things are what you make them, but it didn't register with me. And I remember one day just kind of going through the different majors, right? You back then you had this book, right? And it was this thick book, and it had all the majors and all the classes you had to take to fulfill the major and everything else. And I had already been doing a business minor, and so I had some of the major or some of the core business classes done. the accountings and the economics and stuff. And I remember my economics class, and it was a weeder class for the business school. It was one of those classes where you show up to take a test, and it's a multiple choice test, but it's A to J. And answer M is A, B, C, not D, not E, but F and G. And it was just meant to be absolutely confusing. And if you didn't absolutely know your stuff, then you were going to fail. And I believe the class average was a 40% there for it. And it was just an absolute weeder class. And it was known for that. But it was a class I absolutely loved, and I did well. I ended up with an A in the class. It came naturally to me. It was very mentally stimulating to me. And so I looked and I said, okay, that's going to be my major. And I saw it in the book and I circled it and I said, all right, I'm going to go after that. That's what I started to do. And I remember I was sitting in a class, and University of Utah is known for not being the economics department, not being in line with some of the normal mentalities that are in the U.S. This capitalistic democracy, the joys of democracy, the greatness of democracy. There are a lot of socialists in the department, and some bordering on full-on Marxist communism. And I knew that, and I was a little concerned about it. And I went and talked to a professor, and he said to me, he said, Jeff, look. He said, it is unique about the university that we have professors with those mentalities. But do me a favor. Take every bias that you have, every mental, he used the term brainwashing, that you have had in grade school, high school, over what democracy is, over what capitalism is, over what socialism is. And as you go through some of these classes, derive your own conclusions. Don't buy into any of the socialistic hype. Don't buy into any of the Marxist hype, but read Karl Marx. Read the different stuff and make your own conclusions. And it always stuck with me. And I took a class on economic theory. I absolutely loved it because the whole thing was just going through different economic theories, from Keynes to Adam Smith to Karl Marx, and looking and deriving what our own logical conclusions of that economic society are. And those conclusions were based on incentives. Incentives of the people and incentives of the people who are in power. And you hear me, when it comes to stocks, oftentimes talk about incentives. What are the incentives out there by the major players? Because if we know the incentives, we can understand how it will most likely play out. So we live in a world today that is very capitalistic in terms of its global economy. Very different from what it was 50 years ago. Very different from 100 years ago. It is a brand new market, a brand new economy as of the financial crisis, and as of kind of 2012 and 2011, where global central banks just totally slashed interest rates and made a massive change to the bond market. We live in a new market. So it's very popular right now for people to come out and say, this is going to be a 2-year bear market. And what do they base that on? They base that on the history of the stock market and go, oh, bear markets, they tend to last 18 to 24 months. So, hey, I'm going to come out and say this is going to last 2 years. I'm going to argue here that that's absolute nonsense. That this is not going to last 2 years in any way, shape, or form. And that if we look at the incentives of the players involved, that ultimately we could be looking at one of the biggest V-shaped recoveries and biggest stock market rallies in history 12 to 18 months from now. How does that work? Well, think about the shock to the system right now. You have the global economy, and the global economy is going on, like Netflix, right? It's just chunking along like Netflix here. This is just a 1-minute chart, but we'll use it to match the global economy. And it's just growing, and then it gets this shock. And here's Netflix, and we see it drop. It drops all the way to 300, gets this shock of coronavirus, and people's behaviors change, and they flee to their houses, and social, isolation, and, panic to buy flour and baked goods at the grocery store, and airlines cancel, vacations cancel, Disneyland cancel. People's behaviors, change. It creates a big upheaval. We know how the people are reacting. How are the governments around the world reacting? What are they doing? Well, one of the legacies of Fed Chairman Ben Bernanke is that when economic crisis hits, instead of tightening the system, instead of locking things down, the way you respond to it is by throwing money at the system. You have to get money circulating. If money is not circulating because everybody's in their houses, the economy is going to grind to a halt. It's like a car engine without oil. So the Fed has to put in oil. It has to inject extra oil, money. And we saw quantitative easing programs and just huge amounts and huge gobs of money thrown into the system. And you know what? It worked. In the short run, it absolutely worked. And it had economists, global leaders looking and going, we can avoid the Great Depression scenario by throwing massive money at the system. But the only way we can do that is low interest rates. And so we've seen global interest rates stay low. We have seen central banks not eager to raise rates, knowing that, hey, they now have another tool that isn't just rates. They can now throw money at the system to get it jump-started. So are they eager to do that over the last several years? No, they're not. Why? The economy's growing. So they're not going to throw a bunch of money into the system. In fact, a little bit of tightening here and there, pulling just a little bit of money out of the system. But they're not throwing gobs of new money at the system. There's no reason to. Then we have this thing called the coronavirus. This is one of the most unique shocks in market history. Most shocks that have come into the market have been because of, some very overinflated, overvalued stocks, business contraction that starts to happen around the world due to a number of factors, whether it be oil prices, political tensions. We had the financial crisis, which was this kind of financial engineering and packaging of bad debt, right? So we had systematic issues that created these lulls or these pullbacks in the economy. Right now, this is not a systematic issue, which makes it very unique. This is an issue of a virus changing the economy's behavior in the short run. Is it changing anybody's long-run behavior, assuming the virus runs its course and moves on? No, it's not changing anything. So think about what the players are all doing. All the big players. I mean, we even saw it from U.S. President Trump yesterday. They're all talking about throwing and injecting more money into the system. Great Britain, they threw more money into the system. We're going to see the Eurozone throw more money into the system. China has thrown tons of money into the system. And so we have the major players around the world responding to the coronavirus economic shock by throwing money into the system. Great. Okay. What's that going to do? That's going to loop things up. That's going to at least prevent or do its best to slow some of the economic dip. But why are they doing it? Well, if you look at the major power players around the world in what is mostly a democratic system, how do you maintain power in a democratic system? Can you maintain power in a democratic system if the economy is going down? If people are panicked? No, you can't. You're going to get voted out fast, and you're not going to retain power. Democracy used to be about social issues. It used to be about the people in power are the ones that are on the cutting edge of social change because it helps more and more people. The more social change there is, the more human rights there are, the more people that it helps. Well, now it's about economic equality, economic growth. It's not so much about yes, there still are human rights issues out there. They're never going to go away completely, but they're not to the same degree as what they used to be. Now it's much more about economics, unemployment, keeping populations, growing economically, and staying in power requires that you can do that. Even China, which is not a democracy, China's president and power core know the only way they stay in power is creating economic stability and growth. And so every time there's an economic dip, what are they doing? They're throwing money at the system. So the major power players know that they can't afford a massive dip and a massive panic. They can't prevent it, but they better respond. They better respond big, and they better look like a hero if they're going to stay in power. So the Bernanke model is you throw money at the system, as much money as possible into the system, and you'll be okay. And that's the response we're seeing. We are seeing massive amounts of money flow into the system, and we are going to see much more money thrown into the system. So where's that money going to go? What's ultimately going to happen to that money? Well, let's take a look at this. Let's go to the 10-year bond. Because back when Ben Bernanke was throwing money into the system, back here in 2010, 2011, 2012, interest rates were 3%. Today, down to 1%. We continue to see interest rates erode, continue to see them go down in historic ways. In fact, in many areas around the world, they're negative. So what does this do? This is a major, massive shift in the bond market. And so is that money going to get absorbed up in the bond market? No. Where does that money go? Well, that money gets sat on for the most part initially. People sit on the money. The money that comes in, it's not necessarily spent, it's not necessarily circulating. But as some of the panic starts to wane, as some of the panic goes down, what happens to that money? That money starts getting spent. That money starts to get spent, and that goes into a business who then turns around and does what with that money? They spend it. Everybody who gets that money, what do? They spend it. And you get this snowball effect of increased spending, which with the same amount of money in the system makes it seem like there's a lot more money in the system. It's this loop. And as people spend more, this cycle of money increases the economy. Well, right now, we have governments throwing huge amounts of money at the market trying to grease this up. What's going to happen when economic behavior is no longer controlled by the coronavirus? Yeah, people are going to spend. And now with so much money in the system, the amount of money that is multiplied in the system is going to be ginormous. It is going to be huge, and it's going to be something where global leaders are not going to be eager to kind of sop it up and to pull it back out. People don't like that, right? And what happens when the Fed wants to raise rates? People balk these days. Fed knows they keep raising rates up, they're no longer going to have much power. So what do they have to do? They have to, hold off. And so global leaders are very quick to throw money into the system and very slow to pull it out. So let's just say this coronavirus cycle is 2 months for argument's sake. I don't know. I know what we're seeing in China right now. In fact, this morning, Starbucks announced that 90% of their stores in China are back in operation. That's not enough to push Starbucks up, but that is a big number in terms of, are things starting to get back to normal? I mentioned this morning in my notes some green shoots that we're starting to see in China, and they haven't gotten back to normal. I'm not saying that, but we're starting to see things kick up back to getting back into some sense of normality. It's been about 2 months there in China. So let's just say that we've now been in an unusual circumstance here in the U.S. for about 2 to 3 weeks. So we have about 4, 5, 6 weeks left of some of this turmoil. Well, what's going to happen during that time? We're going to see tons of money thrown into the system. And when things get back to semi-normality, all that money is going to circulate very quickly. Where does the money ultimately land? Where did all the quantitative easing money land? Did it land in people's bank accounts? Did it land in bonds? Did it land in government saving money? No, it all landed in the stock markets globally. And it fueled one of the best stock market rallies over the last 10 years. It was fuel for that. And so now we see a shock to the markets, a shock to the global economy that is different in every way, shape, and form from every other shock. Meaning this is a shock that isn't systematic. This is a shock that could be extremely temporary in the big picture. I know it doesn't feel like that on a day-to-day basis, but could be extremely temporary in the big picture, but have the same, if not more dynamic results in terms of what policymakers and lawmakers do in terms of throwing money at the system that we saw here in the financial crisis, the European crisis, and the years following that. And we could see just as much money thrown into the system within a matter of weeks that we saw thrown into the system in a matter of years 10 years ago. So we have global leaders with incentive to push stocks higher, because stocks higher equals what? Stocks higher is how the global population looks at economic health. For right, wrong, whatever that is how it's looked at, and there's some big flaws to that, but it is the reality. And so economic leaders need to do what? Economic leaders need to push things higher. Throwing huge amounts of money at a system that isn't going to need as much time, as much healing to come back as it did in 2009, 10, 11, and 12. So how will it all play out? Well, I would argue with you that we could be on the border of one of the biggest V-shaped market recoveries in history. And not only that, but a V-shaped market recovery that leads to stocks being 800 to 1,000% higher over the coming 2 to 3 years. Now, I know that's ludicrous to say, that stock's that much higher. That's just pie in the sky bullish hope. No, I don't say that for any bullish hope. I say that because we have what? We have the incentives of everybody involved to do what? Push stocks higher, throw money in the system. We know the result of money in the system. The money in the system no longer gets stuck in bond markets, no longer gets stuck in governments running surpluses and saving money. That just doesn't happen anymore. So all that money, where does it land? It's going to land in stocks. That's the only place it has to land as on aggregate. And as people's behaviors return to normal, the cycle of money, the amount of money that it feels like is in the system, will be so significantly greater than even what was felt in 2010, 11, and 12, that the only place for it to land is here in stocks. Now, you can say, is there going to be inflation? Yeah, probably. We'll probably see, inflation start to tick up. Is it going to be hyperinflation? No. We're not going to see that, because the stock market does what? It pulls some of that out. And so with the way the system is today, with the way the incentives are today, and with the nature of what this coronavirus pullback is, despite all the fear, the panic, and everything else that's out there, when it runs its course, normality will return, and normality will not be the same as normality was 3 months ago. It will be now normal with significantly lower rates, with significantly more money in the system, and with even more incentive from global officials to push things higher. Because the timeline is what? They can withstand a drop, right? The Chinese premier, they can withstand a drop. They can put up with that. They can weather it. But if this persists for months, and even years, what happens to their power? They start to lose their power. You start to see civil unrest. You start to see uprisings, which means power replacement. You look at the U.S. situation with the president, and this whole coronavirus might be the biggest threat to his office, right? To his re-election campaign. But if the market rallies to new highs before the re-election, whether it's his doing or not, what's going to happen? Take a look at European politics, British politics, same thing. A little less in Russia, a little less in some other areas in the world, Iran and Saudi Arabia, right? But in some of the biggest areas of the world, the incentives, the money flows, all suggest, because of the capitalistic system and the way that it works, and the democratic system and the way that it works, and the fact that they can be voted out very quickly, they have to have these upside incentives. They can't look at the long-term picture. They have to look at the ultimate short-term picture. That ultimate short-term picture is throw as much money in the system, hopes the pandemic runs its course, and when it does, people return to normal, and we see a massive, massive rebound. Company comparables will be super easy. Companies will be buying back stock in ways that they never have before. I'm not saying it absolutely has to happen, but I think it's one of those things. When you look at the path of least resistance based on the incentives, V-shaped recovery with massive gain afterwards is the most likely scenario. Now, is that going to start today? Okay, I know I'm going to get some conversation back about this, and no, we're in free fall mode, and yes, we are in absolute free fall mode, and there is no price stability, and we're not talking about a time where the money is kicking through the system. No, even though money's being thrown at it, we're still talking about a system that's grinding to a halt right now. That's the mode it's in. It is still in that mode. That mode will change. It will take more than a one-day pop, right? How many one-day pops have we seen? One-day pops are not going to change that element. We need to start to see that the coronavirus element starts to wane and that people's behavior start to return to normal. And as we see that, maybe not here in the U.S., maybe just more in China and Italy, that's when we will see the bottoms. That's when we will see logic return. And that is when we will see the start of what could be one of the biggest rallies in stock market history. Thanks for hopping on. Have yourselves a great one. And we'll talk to you later. Take care.